Okay, the next section in your workbook, in the risk management piece of the retirement planning process, is a section on life insurance. Now, there's actually about 50 or so pages in your workbook on all the different types of life insurance contracts there are. So at your leisure, I'd suggest you kind of look through them, maybe become a little more familiar with what they are to see if it maybe clicks in your head of what type you might own. Because one of the best things to do as you enter into retirement is we suggest you do an insurance audit to determine exactly what type that you have. Because over the years, last 30, 40, 50 years, there's been a lot of new types of insurance policies that have been introduced, and there's a lot of confusion in the marketplace as far as what type people actually own. In fact, we're meeting with a lot of folks in their 60s and early 70s right now. They're starting to get lapse notices on contracts that they bought maybe 20, 30 years ago, where they understood that these contracts would be paid up when they were 65, but those were based on some interest rate assumptions back in the 80s, and I'm sure all of you in this room can remember what interest rates were like back in the 80s. They're a little different than they were now, so it's important that you understand what type of insurance you've got and what place it fits in your overall financial strategy as you enter into retirement years. The main thing you want to look at your life insurance contracts for the retirement planning process is liquidity, financial management, and future income. When you were younger and you purchased a life insurance contract, probably for the first time, you bought it to create an estate. You were young, newly married perhaps, maybe had one or two children, so you knew if something happened to you, God forbid, you needed some funds to be available to help provide for the surviving spouse as well as for your kids so they could stay in their own home, stay in the neighborhood, stay in their school system. Fast forward 30, 40, 50 years or so, and now you're retired, and now that life insurance can be used for some different uses. To preserve the estate, if you're charitably inclined or you want to make sure you leave money to your kids or grandkids, maybe the life insurance contract can be used for that. If you're charitably inclined, or if you want to have some estate liquidity for estate taxes, or perhaps to refill your estate's asset bucket in the event of a long-term health care need. Now, I mentioned different types of life insurance contracts. There's really two different types. There's term insurance and then permanent insurance. Now, of each of those, there's probably 10 or 20 different types of term insurance contracts and about 10 or 20 different types of permanent insurance contracts. And there's really no perfect one, but it's important to understand the differences between them. And the best example I can give to explain that is the differences between renting an apartment and owning a home. If you're going to rent an apartment and you see there's one available, you approach the landlord, express interest in the apartment. They provide you with a credit application. You fill it out. They do a background check. If you're approved for that, you perhaps present them with a security deposit or the first month's rent, and in exchange for that, they give you the set of keys to the apartment. You move in, you have protection from the elements. You have a roof, walls, a door that locks for security. You have water, sewer coverage. You have heat, air conditioning, etc. Over the years, the landlord's most likely going to raise the rent in your apartment. At some point in time down the road, you may no longer need that apartment. Either you've outgrown it or you move to a different city, and at that point in time, you just tell the landlord, we don't need this place anymore, turn back in the keys, and you walk away. That's term life insurance, quite frankly. You apply to the insurance company for a policy with a certain death benefit. Once they do the background check on you and they approve you, you're covered. If, unfortunately, you pass away too soon, the insurance company sends a check to your household, so you're protected from that case. Over the years, as we get older, the premiums in that contract are most likely going to increase. And at some point in time down the road, when we no longer need that coverage, we just tell the insurance company we don't need it anymore, and they just cancel the contract and you move on. There's no equity built up inside the contract, there's no cash value, so that's the difference between those two. Contrast that to when you bought your home, you applied to the bank, they did another rather exhaustive credit background check, and if they approved you for the home, you agreed to pay them back with principal and interest payments. You'll build up equity inside that home, less in the beginning, more over time, but similar to the apartment, your family is still protected. Provided you don't refinance the mortgage, your premium stays fixed for the life of the mortgage, and you can use those internal equity buildups for a variety of reasons over your lifetime. Sometimes you'll pay off some credit cards, maybe you'll finance some home improvements, but you can use those buildups inside it, and at some point in time down the road, as I mentioned, 65, 70 years old, your mortgage is paid for. That's permanent life insurance. Apply to the insurance company, they set up a payment scheme for the policy of the premium portion, which includes a cash value component that you build up inside the contract. Less at the beginning, more in the end. And much like a home equity loan, you can use those internal cash values for a variety of reasons over your lifetime. And at some point in time down the road, this policy is also paid for where there's no premium requirements required out of your pocket. So those are basically the differences between the two types. Which one suits you is important for you to decide, so it's important that you consult with your financial advisor or the consultant you work with to see which one works for your system the best and which one fits in your lifestyle the best.